Hi, everyone. This is Rob Roy, and welcome to the Elliott Wave Options US Market Update. First of all, Happy New Year, everyone. We were off last week, so a lot to catch up on. Hope everybody had a great holiday season. Taking a look at the market, as we would expect, we've had a little bit of a drawdown in the market. And by the way, the stocks you see on the screen will be the ones featured in this video. And if you have a particular stock you're interested in, you can go right to it by clicking on it in the chapters feature in the video. All right, so when we talk about where we are with the market, it's been in a couple weeks of going nowhere, basically. We went to the upside, we came to the downside, and we also had some economic news this week, led off on Wednesday by the ISM Manufacturing Report. Now, that came in under 50 again, the fourth month in a row. And for those of you that don't know what 50 means, when you're above 50 on the ISM report, it means that you have growth. Anything below 50 means contraction. So it was up a little bit from the last month's number, but it's still showing contraction in manufacturing. So 4 months in a row kind of leads you to believe perhaps we have some sort of a recession, whether it's mild, soft landing, or whatever, in the mix. The next report we had today was the ISM Services Report, and that stayed above 50, but it was down well from the 52.7 reading last month, 50.6 this month. So still barely showing growth in the services sector, but even that's starting to quiet a bit. However, we also had the jobs report that came out today, and that was much hotter than expected. So you talk about how all of the inflationary readings that the Fed looks at have been calmer, kind of getting in that area on the PCE deflator report that the Fed looks at. But the jobs report for wage inflation was one of their concerns. So when we saw that, you saw a pop in interest rates, and we'll talk about that when we get to a chart of the TNX. So that started the market to the downside, but then we rallied after that. And as we move over to the chart of the SPY, you can see that we did finish to the upside today on the SPY. Kind of surprised some people, market pundits, if you will, if you watch any of the financial channels, that we turned and rallied with such a strong jobs report, kind of thinking, oh, are we pushing out those Fed rate cuts? Is there any chance of maybe another rate hike? That seems to be off the table, but the percentage chance of a rate cut at the next meeting went from 60% down to 50%. So it looks like we won't be seeing a toss of a coin, I guess, if you will, on whether or not there'll be a rate cut coming soon. I kind of think that the Fed's going to be late on the cuts, so I don't think they're going to cut quite as fast as the market's anticipating. The Fed usually overdoes things. They go too much to the upside, they go too much to the downside. So I'm not in the camp that the rate cuts are coming anytime soon, but the market has priced in 4 rate cuts this year. So one of the things that I wanted to mention is you hear a lot of talk about the Santa Claus rally. And that's the period of time between Christmas and New Year's where there's no traders around and the market tends to drift up. That old adage that we've also talked about in the past, the market tends to drift up on lower volume, never short a dull market is the expression. Well, I think the Santa Claus rally kind of started back in here around mid-December before the Christmas holiday break as we move to the upside. And one of the things that I've noticed over the years, been doing this a very long time, as you know, if you've been watching us, is because there's very few traders between Christmas and New Year's, oftentimes, once we come back after the New Year's holiday, the market gives back the rally that occurred during the Santa Claus rally. It's like, no, we weren't here, so that doesn't count. So we need to push it back down and redo it. It just seems to work out that way. It's quite interesting. And that's kind of what we're in the midst of now. So we had the rally into the end of the year, and the beginning of this year, we've moved to the downside. One thing I'd like to point out here is that as we moved into the end of the year, you can see that the low of the bar was always above the 10-day moving average, that lime green line. However, since we came back from the break, every one of the highs has touched the 10-day moving average. So we've gone from the lows touching the 10-day moving average to the highs touching the 10-day moving average. So that's our rollover to the downside. I wouldn't be surprised if we come down to test 460. Maybe we don't go that far. today's action certainly has to be viewed as constructive. With that jobs report, we could have had a much uglier day than we had, but we're trying to hold in this area, basically just retracing the Santa Claus rally. As we take a look at interest rates via the TNX, and by the way, we talk about interest rates week in and week out on Trade Finder. And if you haven't joined us for a Trade Finder, you can join us and sign up. It's free on the link provided. We do it every Tuesday night at 9 p.m. Eastern Time. We talk the markets, we look for trade ideas, and we have a live Q&A at the end. We have a great community at Trade Finder and love to have you join us in next week's Trade Finder. So again, interest rates, one of the things that we talk about in Trade Finder often. You can see the chart, the wave 4 is down here at a 71% corrective level, getting awfully close to a level that would disqualify this 5-wave pattern. But for now, we've had a bounce up in rates. And I've been saying that I just don't see what the driver would be to move up to that wave 5. So I kind of expect that this Elliott Wave pattern will become disqualified. But one thing that has happened is the stronger job market has certainly given a little bit of a bounce. But I view this as more of just, the markets don't go straight up or straight down. And this is just a little bit of a correction from this big move to the downside that we've had in rates. So I don't think we're in that wave 5. I don't think we're going to see rates go significantly higher from here. I think we're just correcting that big move to the downside, and that's all that's going on in rates. And, perhaps we go a little bit higher. Maybe we find a little bit of resistance in this area if we even make it up that far. Just can't see the catalyst if today wasn't it specifically to drive things higher from there. Looking at the dollar has also moved to the upside. So you can see that we had recovering the Santa Claus rally. We've got rates going up a little bit. We've got the dollar going up a little bit. That's been a tough road for the market in the past when those two things were going up. And so that's how we started the year. So I think everything is pretty much status quo to start the year. Nothing has been surprising. Everything is kind of how it normally works. And the little concern here on the dollar moving back to the upside is that giving us a little bit of a hint of maybe a global recession? I tend to be in that camp. If you've listened to these recordings in the past, that I've been in favor of not in favor, but a believer that we'll have some sort of a recession, whether or not it's mild or moderate. I don't think it's going to be significant. The economy is still showing a lot of strength, but some sort of a recession, I think, is warranted, and perhaps that's what the dollar is showing us as well. If we take a look at the VIX, well, the VIX headed to the downside today. We had a little bit of a bounce to start the year off of that area that we've talked about for how many months now, around 13. We've gotten below it through the holiday season, so we bounced up, and now we're right back down to that 13 level. That's something to keep an eye on, because if we do bounce again from 13, then maybe we have a little bit more to the downside to go on the S&P, and perhaps we come down and test that 460 level. As I mentioned, looking at some of our other markets, taking a look at the Qs, the QQQ, a little bit of a rough start to the year, as you would imagine, with rates going up and the dollar going up. It hit the tech stocks, and gosh, the media is something else. They're talking about the Mag 7 is now the Lag 7. They just have to have their taglines, and so that's caught on, and they call them the Lag 7 oftentimes now. I think that might be a not so fast, my friend. I think this is a pullback for sure, but I don't think that that's the end of things yet. When we take a look at the Qs, look where the wave 4 is, right at the 38.2% Fibonacci level, trying to hold there, which is a pretty decent fib level, not quite as strong as 61.8, but one to keep an eye on. And then on top of that, we've in an area of resistance. Or support, what was resistance and now would be support. So we've got a good fib level here. We're in an area of potential support. Perhaps we don't have too much more downside to go on the Qs, and that would kind of go in line with my thought that interest rates aren't going to bounce too much higher from here. See how that plays out. Looking at the IWM, and boy, looked like we were going to run all the way up to that 210 level. Remember, way back in the past, we had the 190 to 210 level on the IWM, and then we went down, and the level was 170 to 190, and we broke above 190. And so now you're wondering, are we back in that range where support is 190 and resistance is 210? Kind of looks that way right now. And where this wave 4 is forecast here is right around that 190 level. Remember, these are just target prices. Time and price projections are what they're called. This does not mean we're in a wave 4. It hasn't labeled yet. We're still technically in a wave 3. But if we label the wave 4, that's where you could expect to find some sort of support. And this is a software program from the Hub organization, hubb.com, if you want to find out more about it. It's called Private Source. In fact, I did a live show today. We do one every Friday at 2 p.m. Eastern time over on the Hub Financial channel. So if you haven't registered there, go over on YouTube and register at the Hub Financial channel and join us for a 30-minute Q&A every Friday at 2 p.m. Now, notice that we have filled this gap here on the IWM, and we're in an area of support. I'm anxious to see if we hold that 190 level. That has to be considered bullish. A lot of people look at the small caps as an area of risk on, risk off. So if we can hold this 190 level and bounce and move back into the range between 190 and 210, I think that is certainly bullish for the markets. Other stocks of interest, obviously, we need to talk about Bitcoin. Y'all probably have heard it's been back on the financial channels a lot. There's the approval awaiting that's supposed to come on January 10th on whether or not we're going to be able to have a crypto ETF. We'll find out how that happens. Lots of stories of some institutions getting in front of that, buying Bitcoin. And you can see that we've had a really long consolidation. Today's trade was just under 44,000, 43,000 and change. But basically, since we had this big break above the 39, 40,000 level, we've held in there pretty well. Been some pretty good intraday volatility if you watch that on an intraday basis. So consolidation here is exactly what you'd want to see, and we'll see what happens. If the approval comes as expected, you would expect to see a spike higher, but is it going to be a buy the rumor, sell the news? So I would be a little cautious on any big spike on the news if the news does come that ETF is approved, because perhaps we get a big spike up and then maybe a drawback. But that could be a potential buying opportunity in the crypto world going into the halving that's expected in April. And as you know, we've been marrying Coinbase with Bitcoin. We get asked about this all the time, questions on the website. And by the way, leave a comment underneath the video if you would. You enter into a drawing every single month this year. We're going to do a drawing for one of our L3 subscriptions at ewotrader.com. It's worth several $1,000s, and we had a great year. You can go to our website, ewotrader.com, and take a look at the results there. We're going to give one away every single month. And to enter, all you have to do is leave a comment underneath the video. So Coinbase has had a bit of a drop down, might be a pretty good place to enter. It tends to go along with Bitcoin, even though Bitcoin hasn't had this kind of a drawdown. But we've gotten a little bit vertical here. And you know, I don't like vertical moves. What goes vertically up often comes vertically back down. And that's exactly what happened with Coinbase. So this big vertical move lower, we're getting into an area of support here in the 140 range, which is where we had that little bit of a triangle before we took off. And you can also see that's where the wave 4 projection is if we were to come a little bit lower on Coinbase. But I think this is an area where you can start to look to add some if you're already in Coinbase, and perhaps enter a position if you've missed this move. A break below 140, and I would say that thesis is gone. You want to exit. But 140 is the key level to watch here on Coinbase. Some other things to look at. Oil, USO, the one area that hasn't been participating in the commentary on the financial networks is all over the map regarding energy on whether or not it hasn't participated. That's where we could see some market rotation, or energy is just not going to follow through if we go into a bit of a recession. So there's arguments on both sides. One thing we can argue about is that we have a very qualified 5-wave to the downside pattern here on USO, the wave 4 right there at that 38.2% fib level that we were just talking about earlier. So we hit that and bounced down. Now we're trying to get a little bit of a bounce back to the upside, but we have to say that got to be bearish USO unless we break above this wave 4. Now, if we break above that level there, above that 38.2% fib level, we could go up to 50% or all the way up to 61.8% and still be in a 5-wave to the downside pattern. But really watching oil every day to see if we can mount some sort of a move. But we got a long way to go to disqualify this downward pattern. It looks pretty solid, at least at this point in time. Taking a look at gold, we talk about gold often, as you know, talk about it on Trade Finder a lot as well. We broke above this 190 level, but really couldn't get any sort of a confirmation day. A confirmation day is when you have the second day in a row. So here, this was not a break day that you want above 190. We did come up and test that high on the wave 3 here, but that was it. That acted as resistance. We bumped our head against it and headed back down, and now we've broken back below 190. So you got to be cautious again on gold unless we can get back above that 190 level with a really solid follow-through day. So what you want is a good day with a close above 190 followed by another solid bar with a close higher than that bar. Now that would be a consistent break, something that we would look at that could maybe challenge this level around 192.5 and maybe move to continued upside in the GLD. So looked like we had a bid here. We did, but it just has fallen apart. We'll see how we handle this 190 level. That's going to be key. Meta, which was certainly one of the stars of the last year, is still doing well. Note that it had a little bit of a correction to start the year, but not as much as the market in general did. We held this 340 level, which was resistance back in November. So that's now acted as support. We bounced back to the upside. It's one of the few stocks that's actually above its 10-day moving average right now. As I talked about the SPY being below the 10-day moving average since we started the year. But a nice break above there. And Meta just seems to want to continue its move higher. The wave 5 is only at a 40% extension. So we hit that 38.2% fib extension on the wave 5 and bounced down, tested support. That's pretty classic movement, whether you're looking at general technical analysis or Elliott Wave. So I think if you're long Meta, you have to feel pretty good and stay long Meta. If you're not in it yet, I think you would want to see a break above 360. We get a break above 360. And I think you could have some new longs come into Meta. So pretty interesting there. Tesla, which we talk about a lot, it's not in a qualified 5-wave pattern right now, but boy, has this followed Elliott Wave rules. Going all the way back to this big triangle that we had here, and Elliott Wave, one of the corrective patterns are triangles. The corrective patterns are flats, triangles, and zigzags. And so we had this big triangle, broke to the downside exactly as you would expect it to do. And one of the rules of triangles is they tend to retrace the breakout. And that's exactly what Tesla did. It retraced the breakout right back to the point of the breakout at 260. So it just followed Elliott Wave corrective triangle rules spot on. Now, the question is, where do we go from here on Tesla, right? Well, there is some support here at 240. So perhaps we can hold here. We're trying to hold this level right now. But if we can't hold 240, then it looks like 220 would be the next stop here. I don't see much to stop it between 240 and 220. And if that didn't hold, then we're looking at going all the way back down here to 200. Obviously, that would be a pretty weak market if that were to occur. So I don't know if we make it down to 200, the bottom part of the breakout of the triangle. But there's a lot of congestion right here through November and December, right at the 240 level. So perhaps we hold here. So what would you do if you're trading? If you're long, you stay here. I think you have to be willing to give a little bit of pain down to 220 if you're long. But if you broke that, then maybe we hold 200, maybe we don't. I think a break below 220 and you want to be out But to take a new long on Tesla, I would want to see a break above this 260 level. So if I was long, I would hold. But if I'm looking to enter Tesla, I would want to see a break of that 260 level before I entered. Again, not having a qualified 5-wave Elliott Wave pattern at this point in time. And then last but not least, certainly want to take a look at Amazon. We look at Amazon here, and we ran right up to the bottom part of that wave 5 is labeled right at the 78.6% fib level, which hit the bottom of the tap box, and we've moved lower. So the question becomes, is that the end of the move for Amazon? Or are we going to come down and hold in this area where there is some support? You can see all that consolidation through November and December. It's also the wave 3 high from September. It's also the high from August. So there's a lot of support right here for Amazon. Now, there was some negative reports on the financial networks about Amazon, people calling to sell. I think you got to see it break below this level first. If we come down here to 140 with a breakdown and a follow-through day to the downside, then I think you want to go ahead and exit Amazon. But let's see if it can hold this level right here around 145, because that could just be a normal correction and perhaps an extended wave 5. Or if the end of the wave 5 is in, then we will break below that 145. So that would be indicative, I think, of the consumer pulling back, not spending as much. We talked at the end of the year on whether or not this was going to be it with all the credit card debt and everything else that you've heard about. Was this the last big spending spree for the consumer going into the holiday season, and then the recession's going to catch them? Well, we're going to find out, and we'll see if Amazon is going to lead us in telling us about that. So once again, glad to be back. Happy 2024 to you. Looking forward to a great year. Thanks for watching. Take care, everybody. Recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.